In this video, I will discuss the recent signals we have received on the policy mix and how these shape our expectations on the short-term macroeconomic outlook. To begin with, the central bank revised its communication strategy and signaled a stronger commitment by narrowing its inflation forecast range and introducing an ambitious interim target of 16% for next year. However, second quarter GDP growth came in stronger than expected, leaving the output gap above the central bank's latest projections. This suggests that the contribution of demand conditions to disinflation may be weaker than the central bank had anticipated. At the same time, rate-cutting cycle that has already begun imply more supportive financial conditions ahead. On the fiscal stance, the cash primary deficit has narrowed by nearly 2 percentage points of GDP since April, reflecting efforts to slow non-interest expenditures in line with the initial targets. That said, the growing difficulty of reducing spending beyond earthquake-related needs, also highlighted in the revised medium-term program, suggests that this year's negative fiscal impulse may turn neutral by 2026. Overall, to maintain a restrictive stance and sustain the disinflation process, macroprudential measures and liquidity policies are likely to become increasingly important as rate cuts continue. According to our projections, growth might stay moderate, with domestic demand, particularly consumption, kept relatively modest in the short term. Disinflation continues, but with still challenges, preserving us prudent due to persistence in service items and uncertainties about food inflation and real rates. On Turkish lira, the abundant level of reserves and prolonged high real rates led by the expected slower rate cuts of the central bank will provide buffers. We still assume a limited average real appreciation next year with no changes in our previous exchange rate forecasts. Thanks for listening.